An uninspiring campaign has caught up with Theresa May and the Conservative Party and eroded its Westminster majority, leaving the UK possibly facing the prospects of a coalition government for the second time in 3 general elections. That said, as I sit here, Mrs May is going to see the Queen with the intention of forming the next government. The markets were able to express a view on the hung Parliament result by trading sterling overnight in Asia. The pound has lost around 2% against the dollar, falling to around the $1.27 mark, retracing some of its recent gains. In some respects, it could have been a lot worse for sterling, and that may reflect the electorate's rejection of, or at least failure to wholly embrace, the Prime Minister's so-called hard Brexit stance. However, the pound slide is leading to an action replay of last year's post-EU referendum trading pattern. Today's early moves once the UK markets had opened saw the FTSE 100 rise and the more domestically oriented FTSE 250 fall as stocks took their lead from the currency markets and the big multinationals and dollar earners moved higher. It's noticeable that defensive names with overseas earnings, Diageo, GlaxoSmithKline and Unilever for example, did best in the opening exchanges today, perhaps as a reflection of the prevailing uncertainty. Then, dollar and overseas earners like Burberry and Standard Chartered came to the fore, followed by silver miner Fresnillo and gold digger Randgold, also both potential beneficiaries of a weak pound and strong dollar. The FTSE 100 laggards or fallers were more domestic names, ITV, the house builders Persimmon, Taylor Wimpey and Barrett, as well as retailers and Lloyds, even if talk of a softer Brexit could play to financial services stocks at some stage, for example, assuming it does prove to be more than just talk. Now, in the very short term, Mrs May's dash to reinstall herself in number 10 Downing Street may help to calm markets, even if she may still have a lot of work to do to stay there. Remember that back in 2010, the FTSE 100 fell 2.6% on the day after the election of the 6th of May of that year, which threw up a hung Parliament as well. The index then rallied 5.2% on the following Monday, when incumbent Prime Minister Gordon Brown resigned, and overall it recorded a gain of 2.3% from the day before the ballot to the announcement of the Conservative Liberal Democrat coalition on the 12th of May. The scope for short-term swings is therefore clear, but note that markets did calm down pretty quickly as economic and company fundamentals reasserted themselves. Over the 12 months following the 2010 election, the FTSE 100 rose nearly 14%, while the 10-year gilt yield fell, so its price rose, from 3.74% to 3.4%, helped by the Bank of England's quantitative easing bond buying programme. Meanwhile, the pound gained 10% on the dollar, lost 4% against the euro in the 12 months after the poll. This was all as much due to the fundamental backdrop, a recovery from the financial crisis, and ultra-loose monetary policy from central banks the world over in the form of falling or record low interest rates and QE. UK politics next to that lot meant relatively little. Investors therefore need to cut out the noise and assess both company fundamentals and valuation, as it is cash flow and profits and the price you pay to access them that ultimately drives returns from individual stocks or bonds or even an entire index of them. Ask yourself this key question: does a hung Parliament, coalition or minority government really mean that customers will stop buying a company's products or services or insist on paying a lower price for them? Where the government is the customer, or the biggest customer, that could perhaps be the case. But in many others it may make no difference at all, and under those circumstances, any uncertainty-driven drop, well, could even be a buying opportunity. But if investors are in doubt as to what the election might mean, they will probably be best served by doing nothing. This will at least mean that you avoid incurring brokerage fees and commissions, as well as other frictional dealing costs such as spreads, potentially stamp duty, even tax. Thank you for watching, and I look forward to seeing you next time.